On August 25, Jerome Powell, the chair of the Federal Reserve, addressed the nation's economic concerns. He shared that the Federal Reserve might need to take more steps to combat persistently high inflation. Powell emphasized the importance of proceeding with caution during upcoming meetings, carefully weighing the progress made in reducing inflation against the surprising strength of the U.S. economy. Speaking at the annual Jackson Hole Economic Policy Symposium, Powell explained that the Federal Reserve would exercise prudence when deciding whether to continue tightening monetary policy or maintain the status quo while waiting for more data. He made it clear that it is the Federal Reserve's duty to bring down inflation to their desired 2% target. Since March 2022, the Federal Reserve has raised interest rates by a substantial 5.25 percentage points. The result has been a decrease in inflation from a peak of 7% last summer to a current level of 3.3%. Powell acknowledged this as a positive development, but he also acknowledged that inflation remains higher than desired. Powell assured that the Federal Reserve stands ready to raise rates further if necessary. They intend to keep the policy rate at a restrictive level until they are confident that inflation is moving consistently toward their target. However, Powell voiced concerns about the economy's unexpected strength. Factors such as robust consumer spending and a potential rebound in the housing sector could jeopardize the progress made on inflation and necessitate additional tightening of monetary policy. In his speech, Powell highlighted the challenge the Federal Reserve faces in interpreting mixed signals from an economy where inflation has slowed without significantly negative consequences. This situation presents a dilemma: whether the current policy is sufficiently restrictive to achieve their goals. Unlike his speech the previous year, Powell did not issue a stark warning about impending hardships for households due to further policy tightening. However, he didn't suggest that rate cuts were on the horizon either. Market expectations following Powell's speech indicated a less than 20% chance of a rate hike in September. Still, there was a better-than-even chance of the policy rate ending the year slightly higher than its current range. The yield on the 2-year Treasury note also saw a notable increase. Powell emphasized the challenge of determining the exact position of the benchmark interest rate relative to the neutral rate and assessing the Federal Reserve's impact on growth and inflation. He outlined the factors contributing to inflation, including increased goods inflation during the pandemic and a decline in housing inflation. He also expressed concerns about ongoing consumer spending on services and a tight labor market, potentially hindering a return to the 2% inflation target. Jerome Powell's tone was less stern than the previous year, but he remained cautious and did not rule out any policy options. He emphasized the Federal Reserve's commitment to monitoring inflation and doing what it takes to achieve their objectives. Other Federal Reserve policymakers at the conference held various opinions on the future course of monetary policy, with some suggesting that the focus might shift to how long rates should remain high rather than how much higher they should go. Powell ended his speech by reiterating the Federal Reserve's determination to continue working toward their goals.